like these little owls that they have here. They keep an eye on you. Okay, I'll say Simon Says you may gently take your seat again. And I'm going to talk about insurance issues. As mentioned, we'll go with next slide, please. I work for United Policyholders. It is a nonprofit that evolved after the tunnel fire in the Oakland Hills. People with insurance claims issues after a major event like that. A lot more goes wrong with your insurance than you think. And I'm going to talk about some of those issues as part of this presentation. But that's how UP evolved. We never charge anybody, we assist anything. We run on grants and contributions. Next slide, please. So I'm going to talk a lot about how the insurance world is kind of working today. Those of you who are homeowners or renters and you have insurance, you probably have noticed your premiums are going up at a pace well beyond maybe anything you've seen in the past. So I was looking at to get a rate increase in California, admitted insurers have to request approval from the Department of Insurance. A couple of years ago, State Farm got approval for a 20% rate increase. Insurers almost never ask for a double-digit increase, so that was pretty significant. But that's what State Farm, requested and was approved at that. It looked like their loss events were increasing at a level that justified that rate increase. But when you hear a 20% rate increase kind of maybe in the paper is going forward, that doesn't mean everybody gets a 20% rate increase. It plays out differently all across the state, depending on your specific home. So for example, the way that one played out, San Bruno, 18.3. I was just there last week for a presentation. Los Altos and Los Altos Hills, you can see here, did relatively better than most other areas. So 16%, 12%. I did a presentation a little while back in Ojai. Ojai, down towards the bottom there, 75% on average increase. Now, these numbers are also averages. So not everybody in that zip code got that exact amount. So as you can imagine, people who have a little higher risk, meaning probably the ones that are a little further up the hill, they actually paid more. And people who were a little closer to the fire department or town might have paid less. So, for example, there are probably people in Ojai who received over 100% rate increase. So these are the way when you read something in the paper about, a rate increase being approved, the State Farm went back and asked after this was approved for another 30%. And they ended up, I think, getting 17% approved. And that 17% is actually going to roll out, I think, for everybody about the same. But this is how these rate increases play out across our homeowners kind of landscape. Next slide, please. We're letting that one settle in.
Excuse me? Why are you using State Farm and just as representative of other?
Yeah, I'm just using State Farm because they're one of the larger homeowners insurance companies in the state.
And so other insurance groups.
Every insurer is asking for rate increases right now, and many of them are asking for double-digit increases. And I will say one of the reasons they typically haven't in the past is because in California, if you ask for 7% or more of an increase, a consumer group can intervene in the process and demand a hearing. If you ask for less than 7%, a consumer group can intervene, but they can't demand a hearing. So insurers in California, since Proposition 103 passed a couple decades ago, Generally, every insurer requests 6.9% increase. And as soon as that's approved, they ask for another 6.9, right? But they keep it below the hearing kind of trigger. But, in this current market, they're feeling like, we need this money faster. We're gonna take the risk of a hearing. And in the State Farm case, it didn't have to go to hearing. Their second request, the one that came in right after that, did have to go to hearing. So they started at 30, they reduced it to 17, their request, but there was still a hearing over whether that was able to be justified.
Joel, question?
Yes.
I probably get straight man, you're probably setting up to talk about this, but my question is, given those rate increases, how from an economic standpoint do these private insurance company offerings compare to the state last resort program? And then along with that, how is the coverage, how does the coverage compare as well? It's not just a price comparison, so I've heard some things about the state program where it's not very good. And then maybe it's worth it to stay with a private company at a higher price.
Yeah, and actually, I'll say, I will get to that with a slide in a little bit. And if I don't, you can point a finger at me to remind me, what about my question? So just again, an idea of how rates work and who gets to be renewed and who doesn't. You see these, speaking a little like owl-like eyes, I have two red circles up on the screen here. And you can see there's the Gardner Bullis School right nearby. You see these two little red circles. What they are representing here is how an insurer can underwrite or determine what it's going to write and what it's not, or who it's going to charge more premium or not. This says two homes are kind of in the center of each, a home in each of the red circles here. There's one in the middle. And 30 years ago, those two homes would probably pay about the same premium. If an insurer was willing to write one, it'd be willing to write the other. But those things have changed since insurers have developed or implemented wildfire risk scores. So even though those homes might be just less than a block apart, one may have a slightly different score than the other. And that risk score impacts the premium you're going to pay. So one might pay a little more because it's a little further up the hill, or it's a little closer to the closest fuel load, right? Where there might be a hillside or a mountain. So if you're a little further up the slope, you pay a little more. But also there may be a cutoff of eligibility between those two scores. So, as you go up a block that goes up a hill, there's the last house that the insurer will write. And then the house next to it has one notch higher score and they won't write it. So things that didn't make a difference 30 years ago when they were only using the zip code and your fire protection district or that type of measurement have changed to what we call a lot more granular rating and underwriting, where they really distinguish between one house and another based on these risk models. Next slide, please. In fact, it's that last one was based on kind of satellite imagery. Insurers now use aerial imagery. So then they're looking at a home and they get a lot more detailed view of the home. In this case, you can see that there are tree limbs overhanging the roof. Now, the insurer would not have known that about your house unless they sent out an inspector. And insurers rarely have done that in the last couple decades. But now they're able to get this information just from the aerial imagery. And these images also generate a score besides identifying very specific risk issues at the home. So in this case, I don't know, maybe that's an oak tree. It may not be as big of an issue as some trees, but they're certainly not going to want those tree limbs to be right above the home. At the very least, they're going to want that limbed up So even if it does overhang the roof, it's 15 feet above the roof or 10 feet. So if this is your beautiful oak tree, that may be an issue. And, you know, of course, in some cases, they don't want a tree limb at all projecting out over your roof line. And so it depends on the insurer, it depends on the type of tree, but this is now the new normal, I'll say, of insurance underwriting and rating. That they're gonna see these things, they're gonna ask you to deal with them, or they are going to non-renew you. And so, you know, when you get that non-renewal notice, there are some things you can deal with and some things you may not be able to deal with. You know, in the last slide, when I said, you know, you're going up a hillside and they decide not to ride this much higher up the hill, unless you can flatten off your mountaintop that you're on, there's nothing you can do about it. In this example, you may be able to do something, right? And you might have to sacrifice your tree even to keep your insurance, which may be worth doing in the current insurance environment. Next slide, please.
Excuse me?
Yes.
Where do these images come from? Are these Google images or do the insurance company sort of sub out and get aerial images?
Yeah, they use they use entities or companies that take aerial imagery, purchase aerial imagery, and provide a scoring mechanism for that imagery. So they use one of them is called Zesty AI, for example. They get these maybe every 3 months. They're getting new aerial imagery of, you know, every home an insurer has on its book of business. And they do an evaluation that takes into account those details as well as things like slope and in fact, I'll say one thing that's even kind of new built into it is they already build in the age of the home. So they have from the county records or state records, what year your home was built. So if your home was built in the 60s, like mine, they know what kind of vents were the code at the time. So they are the, you know, big square vent hole grids. So they know those are unacceptable. They're gonna, you know, we want the tighter mesh. So you may be told, oh, you know, you probably have this older mesh. And so you're gonna need to replace it or be non-renewed. So it's all about getting more data. They just have more data today. And they can also tell whether that's a wood shingle roof. I'll add that as well from those images. So they're getting them from entities, not the insurer doing it itself, but they are buying this data download and scoring process. Same as with those prior models.
Does the CAL FIRE,
Thank you.
thank you, Denise. Does the CAL FIRE system, you know, the scoring system affect insurance?
No. No, because insurers are buying these other models that are more detailed and specific to the home, they're not using those CAL FIRE maps of high hazard. So we just had an update to those maps. And people are concerned, well, now my community is a very high hazard. That's not what insurers are using. They already know about your roof type and your vent type and what the slope is and where the fuel load is. So they've been kind of ahead of it in terms of what they're concerned about. So,
I just also on the foyer, I have the office, State Fire Marshal's office, frequently asked questions about that topic specifically. So those are fire hazard severity zone maps. It's around hazard, not risk. So risk should have many more components like he's speaking to versus just, these are just historically looking at slope, topography, open space, vegetation location, things like that. So your good insurer will not be using just that map. So thank you.
I wouldn't put it, past an agent to say, well, we were just, rated very high fire risk. So they might use that term broadly or something, but that is not accurate to the actual undertaking of what insurers are using. So, one thing, and you should all know this because insurers need to tell you this, and that is there are a set of discounts available to every admitted insurer and fair plan insured that if you take these actions, you will get a discount for them. This is the Safer from Wildfire set that the state agencies came up with, working together. And the same things that we just heard spoken about, right, in terms of what you can do around your home. The Class A roof, meaning no more wood shingle roofs, of course, enclosed eaves, fire resistant vents. And I know there was a question about vents a minute ago. I did recover my own 1960s vents with mesh. My fire chief said, oh, that's one you can do yourself. And I kind of was skeptical because I also have a very low skill level in doing anything around the home. But I did buy a roll of the tight mesh, and I bought a pair of snippers, and I actually was able to pull out those vents, wrap this new mesh around them and shove them back in. And I think I probably saved myself some money because, there's like 30 vents around the bottom perimeter of my home. You probably need someone perhaps to do the ones on your roof if you're not as stable as you might think. But you can do some of this yourself if you want to economize or prove to yourself what you can do. But in any case, there is a set of discounts every insurer has to offer. So, check that out. Even the Fair Plan offers these discounts, but for the Fair Plan, you have to do all the building ones to get the building discount, and all the landscape ones to get the landscape discount. For all the admitted insurers, each one of these is a discount. Now it's a pretty tiny discount. So when you're getting a 79% rate increase, a 2% discount for enclosing your eaves isn't, that great. But I think what is going to happen over time is as homes that have done all of these prove that they survive wildfires, then those discounts are going to go up. And not only that, it's going to be about eligibility. So, do it today, you get a discount. But if you don't do it, maybe 2 years from now, you get non-renewed. So there's always this, two-headed dragon about, doing the mitigation. One of it's just, because you want to do it right, but other is to keep your coverage. Next slide, please. So if you do get a non-renewal notice, has anybody here been non-renewed or hopefully not? Okay, sorry, everybody that had that happen. An insurer has to give you 75 days notice. That's probably the longest of any obligation through state law. But they have to give you notice, they have to tell you the specific reason why. And I know it's a bummer to get that notice, and what you want to do is probably just put it aside, not think about it for about 2 months. But that's not what you have to do something much different from that now. You need to get shopping for coverage. So there's one thing. The other thing is because they told you the specific reason for the non-renewal, you want to see if it's something you can change, right? If it is because you still have a wood shake roof, you want to see if you can get that wood shake roof replaced within those 75 days, right? And then argue that you should be renewed. So if it's about enclosing your eaves, you want to get that done. Whatever it is, if it's within your control, which it very well may not be. But if it is, try to get that done so you get your renewal. If that's not likely to happen, you also need to get shopping because this is a very challenging market to find another insurer that will write you, especially if you're out of, the kind of downtown area and up a hill. So you want to get shopping and really do the full market search that is possible. Next slide, please. So I'll mention these are just common reasons for non-renewal. Number one, wildfire risk or fire risk, age of home, age of roof. Some of those are things you can deal with because they are based on whether you've updated your electrical or your plumbing, that type of thing. Knob and tube wiring, that's more of a Victorian home issue. Some homes in San Francisco are getting those notices. Trampolines, things like that are liability hazards. So insurers are looking at ways to thin out how many insureds they write in any given area to reduce their exposure if they feel they've written too much business in too close a vicinity to each other. So next slide, please. So again, know you have rights, and insurer needs to give you discounts if you do those things. An insurer should renew you if you resolve the thing that was the reason for the non-renewal. The insurer has to give you information about discounts and about why you're non-renewed or what you can do to lower your premium. Next slide, please. And one thing to keep in mind, if you do get a non-renewal notice or you've ended up with an insurer whose premium is skyrocketing, there are lots of companies that write homeowners insurance coverage that you've never heard of. Tokyo Marine Insurance Company, Wawanesa Insurance Company. These are probably ones you may never have heard of at all. On the Department of Insurance website, there's a page, this is under the residential insurance. You can see there's a top 10 tips link. I happened to write that link when I was working there, but what it has is that one of the things of those top 10 tips is the 800 number of every one of those admitted insurers that write coverage, homeowners coverage in California. You want to be with an admitted insurer if you can. But you can call that 800 number and ask, do you have an agent nearby, or can you give me a quote directly? And that's a way to find out, maybe there's a local agent that represents Tokyo Marine, or Wawanesa writes directly. They don't do business through agents. So there's more than State Farm, Allstate, Farmers, there's a whole bunch of companies. It's a challenging market, so you can try a lot of these companies and still find nothing, I will say, but it is worth the search before you settle for a fair plan policy. There's Home Insurance Finder tool that also might do some of that work for you. So next slide, please. Here's an example of that 800 number list, and you can see California Capital Group or Unitrin Auto and Home Insurance Company, just to emphasize, there's probably a lot of insurers you've never heard of that write homeowners business in California. Next slide, please. So one thing, premiums are going up. What can you do to save a little money? I'll get right with you next. So one thing, when I bought my homeowners policy, 20-something years ago, when we moved into our current home, we chose a $500 deductible, because that is a lot of money to have at risk before before you make a claim, $500 whole dollars. And then we renewed that policy year after year, never changed that $500. But $500, fortunately, doesn't mean as much to me anymore. Like, I can afford to handle a little more of a loss. So I should be raising my deductible, and that's what I'm recommending you do too. Look at your deductible. You're not going to make a $500 claim, even if that is your deductible, because you don't want your insurer to think you're not maintaining something, or that there are other risks at your home, or to come out and see everything at your property. So you want your deductible to be at whatever level you can reasonably afford to handle the loss yourself. maybe you can handle a $10,000 deductible now. So that will reduce your premium. You know, you'll have some exposure yourself, but if you can handle that level of loss, that's where you should push your deductible, right? Don't be keeping that old deductible from years ago. So that's one thing. All those mitigations I mentioned earlier were another way to lower your premium. So you want to contact your agent and ask if are there any ways, you know, to lower my premium. If you don't have your auto and home combined with the same carrier, you might ask if your homeowner's insurer writes auto. And if you're a good driver, they write auto, and you're a California good driver, then see what the quote is. It may be better to pay a little more for the auto than you do with another carrier, but get a discount for the multi-policy discount. So it just takes a little work. We mostly don't like to think about insurance, but pay the premium and stick it in the drawer for another year. But maybe you have to do a little work now to make sure you're, optimizing the discounts and making sure, you have the coverage you need. Next slide, please.
Oh, let's talk.
Yes.
Hi, thanks. This is a very helpful and informative presentation, so I really appreciate it, especially with the background that you have. I was non-renewed 2 years ago, and I went through the list, contacted every single insurer, contacted 40 agents, couldn't get anything. Eventually had to choose between the fair plan and something called surplus line.
Yes.
I was wondering if you could speak a little bit about the non-admitted insurer option. I think that's called surplus line, but there may be other classifications as well, because some of us are going to be impacted by that.
I will have a slide on that specifically. Give
Awesome.
me 1 moment.
Thank you.
So thank you. Good question. Oh, wait a minute. What's this slide? So, yeah, there are different categories. So timely question. There are different categories of insurers. I mentioned that 800 number list that you can find on the department website. Those are admitted insurers. What is good about an admitted insurer? They're all backed by the California Guarantee Association. So if one of those companies did go insolvent, its claims would still be paid by contributions from all the other admitted insurers. So when we had the fire up in Paradise that devastated, a huge community there, the Camp Fire, there was a small insurer, I think it was Merced Property and Casualty, that went bankrupt from their claims. They had written too many homes too close together, we talked about earlier. But all of Merced Property Casualty's claims got paid because the California Insurance Guarantee Association kicks in the funding to pay all those claims. So that's a big advantage of having an admitted insurer. Also, their rates have to be approved by the Department of Insurance. So it means they're more aligned in terms of reasonable compared to the insurer's losses. So there's that. Non-admitted or surplus insurers don't have that guarantee. So if you end up with one of them, you have to really do a little more homework to make sure they have a good financial rating. The financial kind of expertise that most people rely on is of an entity called BESTs. So you want to look for a best financial rating, at least a B+, and obviously better if it's an A minus, or an A+. If you get a low rated, like a C rated best company, right? So a non-admitted carrier whose best rating is a C, that means they're a little, iffy on the solvency issue, if they were to suffer a major event. So you want to, if you're with the not surplus lines, no financial guarantee other than the strength of the insurer itself. So that's a little bit worrisome. And of course, they can change their rates at will at any given time. There's, no cap on what they can do to make sure they're reasonable or not reasonable. So they tend to be expensive. And when they're in a market where there's no competition, their premiums just rise on their own. Government created, California Fair Plan is a state created agency in law. It is financially secure because if the Fair Plan ran out of money, it would assess all those admitted insurers and they would kick in the money to pay the Fair Plan's losses. And actually, now those admitted insurers get to pass on some of that to all of their customers. They can ask you to pay half of their load, which didn't exist until this year. But insurers insisted, well, if we're gonna continue to stay in California and we have this risk of paying Fair Plan losses, then we're either gonna start writing less business or you're going to allow us to pass through some of those assessments. It's getting way into details, so I'll stop there. But the Fair Plan, the important news here is that it is financially secure. So that's the good part. There's a lot of bad part. And then there's forced place coverage. If you have a mortgage on your home, and most people do, you are, the terms of almost every home loan is that you have to maintain insurance coverage. If you don't do that, your lender will place coverage, you'll pay for it, and it won't cover anything that you own. It'll just make sure that their $500,000 loan, or whatever it is, will be paid off in the event of some kind of total loss, right? So then you'll be paying for coverage that doesn't even cover you. So you really want to keep the coverage in place, even if it's pricey, like the Fair Plan coverage. So those are hopefully that answers your question about surplus lines carrier. Next slide, please. I'm going on way too long.
Yeah, you're fine. You're
No,
perfect.
I'm good?
Yep.
Okay, and one thing I'll mention again, UP Help, we have at uphelp.org, we have a lot of information on all of this. If any of this is confusing about insurance coverage, it's all free. It's the same admission cost that you paid for listening to me drone on, nothing. So check us out. One thing we want to make clear about the Fair Plan, it is very thin coverage. It's mainly a fire policy. And it satisfies the bare essentials of your loan requirements. And it will potentially rebuild your house, but it doesn't cover the array of coverages a homeowner's policy has. For example, so you can see the Fair Plan is like fire, windstorm. Water damage is one of the most common causes of loss for homeowners. Plumbing bursts, especially two-story homes. Plumbing bursts upstairs, ruins your ceiling of the downstairs, right? Or you have old pipes and something goes wrong. So water damage is a big one. That's not covered by a Fair Plan policy. Liability coverage. Somebody trips and falls on your property and is injured, and they want to sue you for that, or they need medical help and it's expensive. Well, Fair Plan policy doesn't cover that, but that's covered in a homeowner's policy. So with Fair Plan, you have to buy another policy, despite the Fair Plan probably being more expensive than your homeowner's policy was. It's just that very thin coverage, and you have to buy yet another coverage. What they call it a wraparound or a difference in conditions policy to cover water damage and liability. Liability claims are seldom, but you could lose your home over, somebody injured on your property. So you want to have those coverages. So together they represent comprehensive coverage. Basically, together they are what a homeowner's policy would provide on its own. So it gets very expensive, of course, this combo, but you really should purchase both. Next slide. And if you have a mortgage, you're gonna need at least the fair plan policy. Underinsurance is a constant in almost every catastrophic wildfire loss. People do not have the necessary limits to rebuild the home as it was. And every other year, at least I think by law, your insurance company has to send you information about how much it would cost to rebuild your home. And you look at it and it seems pretty detailed. Yeah, okay, this looks like my limit is adequate. It almost never is, almost never. And particularly if there is a catastrophic event, you know what happens to construction costs and labor costs? That goes way up. So if you were underinsured on a one-off loss, right, just your home burned, now you're way underinsured. So you want to look and get a sense of what does it cost to rebuild it where I live? Is it $400 a square foot, 500, 600? And at least get yourself in the ballpark of reasonable for your limit, right? Nobody's looking to increase their limits a lot because it increases their premium. But you do want to get a limit that's at least going to be in the ballpark of allowing you to rebuild your home. So be careful about that. Next slide, please. One thing we always mention as well is inventorying your personal property. If you had a major loss today, a non-catastrophe event, just your home, your insurer can require you to get your contents coverage paid to list every item you had, to say when you bought it, how much you paid for it, and what condition it was in. And so you end up doing this huge, long inventory to satisfy their requirements of documenting your loss. And for most people to think of everything in your home off the top of your head after you've been through something like this big fire is too much. But what can significantly help you with that claim is to just take your phone and video the contents of your home. So walk through your home. So this is easy, right? A better way is to write everything down that you own when you bought it and have it all in a list in a safe deposit box. But who wants to do that? But this, at least, walk through your home, video everything in your closets, in your drawers, in your cabinets, and in your furnishings. So at least you have evidence of, yes, I owned all this, right? I'm not making up that I had 2 couches or whatever that they find. Well, most people only have 1 couch. So you're gonna need to give us some documentation. At least you have some evidence. That can help a lot of times in them not requiring the inventory, particularly in catastrophic events where they just really don't want to go through everybody's whole process anyway. But, you know, so this is something, and it'll also remind you of things that you will have forgotten about once you do have a loss, right? You wouldn't remember that, you know, leather coat or whatever it is. Next slide, please. So where's this all headed? Well, the Department of Insurance took an initiative to hopefully make the market more accessible, called their Sustainable Insurance Strategy. It is going to allow insurers to use wildfire projections of loss in its rating. Right now, they only can use actual historic loss histories. So now they're going to use models that say, okay, you know, this vicinity, we expect a 30% increase in the number of catastrophic events, and that will be built into your rates. They are going to allow insurers to pass their reinsurance costs, reinsurance being the insurance that insurers buy to cap their losses. So they're going to be able to pass on those expenses to you. right? Currently, they can't do that in California. They can do that in every other state, but not here, because we've had better consumer protections. So what does it mean? Premiums are going to be going up significantly more. So those ones that we were talking about, that's even before these laws changed. But they're going to rise even higher with the hope that insurers will then be willing to write more coverage again. Right? Insurers have been complaining, we don't get adequate rates in California because of all these regulations. So the regulations have been diluted essentially. And now hopefully the insurers will come back. Or maybe they'll just be happy to get the extra premium and won't come back is the problem, but we shall see. Next slide, please. But that's where we're headed. And again, uphealth.org, we hope everybody would take our home survey just to give us more information. And I think the next slide is my farewell. It is uphealth.org. I'll take any other questions and leave it there.
Can you speak to how Firewise is interacting with the insurance? Like part of the reason for joining Firewise is having a better relationship with insurance, less likely to be canceled, maybe even getting a discount.
Can I ask one more question alongside that? He had a Firewise question also, so that we can hit them both together.
Yeah, you gotta remember this now.
I'm in Tahoe on the unfair plan, and
The unfair.
I submitted my Firewise certificate, and the number came back exactly the same, no discount.
Just,
Okay, so first I'll say this, insurers have to give a discount for Firewise. I'll have to figure out what the Fair Plan's discount is. The Fair Plan had required you do bigger sets of the activities, the mitigation actions, but they should be giving a Firewise discount.
for mine, it was originally 7% plus some individual, if you did the 0 to 5 feet, if you did trees, they did additional percentages, but it was, for me, 2 years ago, the fair plan was 7%. Yeah.
Also on the invoice, it doesn't show any discount, it just shows numbers, their invoices are horrible.
Yeah, well, the Fair Plan itself is a bit of a mess, I gotta say, but they should be giving you a discount. And in fact, so every admitted insurer has to give a discount for Firewise communities. It does not mean that they have to write you though, right? So you can do all those mitigations and you can be in a Firewise community and still not be eligible for coverage with an insurer because those aren't necessarily their underwriting standards, right? Their underwriting standards are based on those pictures I showed you of what the slope is or the vegetation that's nearby, or whether you have issues around your property in terms of the tree limbs. So, you know, if you're within their scoring that is eligible and you do the mitigations, you get a discount, and they should be specifying what those discounts are. Some of the most motivated people to join Firewise and do the work are often ones that won't be eligible. Unfortunately, if they do that, because they're just at a higher risk level than insurers would write, no matter what you do. So you can do all the mitigations and still not be eligible for coverage with a given insurer. That's a reality of today's insurance market.
If you have coverage and you join Firewise, are you less likely to be dropped?
I don't think it's a trigger one way or the other, right? Some people have been afraid to contact their insurer to tell them anything, but that is not, it's not going to get you non-renewed. There are probably coincidental times when somebody's submitted that and they got a non-renewal next time, but that wasn't because they joined a Firewise community. I'll say this is a technical thing, but the discounts don't cost insurers anything, right? You think like, oh, I paid $1,000 less. But the insurer, when they ask for rates, what they're gonna get is $1 million, let's say, in a year. And some people will pay a little more of that and some will pay a little less of it if by the insurer giving a discount. So if if you give a discount, just like if Target sold something for $1 and then they decided, if you do this, we'll give you 20% off. Then the price rises to like $1.10 and you get the 10% off, but overall, the Target still gets the same amount of money from that sale. That's how insurance is. They get all their money no matter what discounts they give. So giving somebody a discount doesn't make them want to non-renew you. It's like, okay, it's fine with them. So do the mitigations. They can only help. And, for some insurers, they may mandate that you do those to be eligible. So if you're looking to go somewhere else to another insurer, having done those can help you. They can't hurt you. They can help you, but they're no guarantee of eligibility. That's how these mitigation actions or being in the FireWise community works.
Online question? Yeah, we have one on. Hello, hit the button.
We have one online question. Can we go back to the survey slide, please?
Keep going.
Nope, that's it. So here's the survey that Joel has asked folks to participate in. We've got 19 people online. Woohoo!
Yeah, and we use this information to help us support legislation or suggest legislation to address some of the issues that people are having, or to be able to speak when we come in to talk about an issue, to have more than anecdotal evidence or thoughts of what's going on. We need kind of some degree of credibility behind what we kind of project out there broadly to the press, to the legislature. We are constantly working and called upon to testify on in terms of changes in legislation to insurance requirements. But I guess I'll end with, unless there's more questions, is don't just put your insurance aside. Make sure that you are doing what you can to mitigate if you can, or raising your deductible. You're making sure that your insurance is going to pay to rebuild your home, or within the ballpark at least. And you're going to inventory your contents. But it's really, you don't ever want to use your insurance, and that's why the mitigations are important. But it's also doing all the other things around your home that are within your control. A lot of this is beyond your control. And I know it puts stress in families about their insurance and nobody liked insurance before, and now they like it even less as a topic. So, but it's just, this is part of, I'll say, another new normal thing that we have to deal with. And the only way to get past this issue is when we start having fewer wildfires. And the only way to get there is to doing everything we can at our home. But it also is going to mean shaded fuel breaks and, landscape-wide activities that we're willing to pay to have done on a broad scale. Because we can't just do this by ourselves, and we built ourselves into environments that sometimes just aren't, they need a lot of work to improve access and all that. So hopefully that's where we'll be looking to do over these next decades. So thanks for listening to someone drone on about insurance for 55 minutes. That's a record.
Amazing, Bill, thank you. Just so everybody knows, and online also, we will be providing the recording of this whole event, and we'll have the slide decks available so that you'll get an email if you register, giving you that information and those links. Again, restroom to the back, it's 3900 checkmark. Make sure you use the privacy button. City Council, which is a nonprofit whose mission is to support wildfire preparedness on multiple layers. I won't do you justice on